Hi, everyone, again. It's Nate. So we're just going to get started. Just for those of you who maybe haven't joined one of our calls before, or if you have memories fade. So what we normally just do is I just kind of do a presentation for 15 minutes or so, and then we'll invite participants to ask whatever questions they like, and we will do our best to navigate through the answers. Okay, so when we report our annual returns to our clients, the very first benchmark we utilize is a blend of the S&P 500 and U.S. bonds. Now, what always happens invariably, the portfolio returns will differ from this crude benchmark, and the primary driver of the deviations is the fact that our investment portfolios, and in fact any properly diversified portfolio, contains international investments, whether stocks or bonds, whereas in that American benchmark, of course, it's just U.S. stocks and bonds only. So the results from the international investments become very important in not just the impacts on the top line of the return, but in also creating and driving deviations from the benchmarks that we're most familiar with. Okay, so at this point, you're probably saying to yourself, gee, thanks for that fascinating explanation, Nate, but is there a reason you're telling me all this? Yes, there is. And here it comes. The international investments have badly trailed their American counterparts thus far in 2018. So for instance, through August, the S&P 500 is up 10%. A world stock index is up just 5%. And an index of foreign stocks, the world excluding the USA, is actually down just over 3%. So that's what's happened so far in 2018. And before we contemplate what to do now, whether we should make changes, stay the course, do something completely different, we need to really understand why the market results have unfolded the way they have. And as to that why, as I've identified it, most of the causes of the struggles in the international markets have kind of emanated more from the U.S. itself than internal issues in the various nations. And I'll try to go through them, perhaps not in the order of their importance, because that's always hard to ascertain, but some of the reasons that have weighed on the international results. The first one I have is the huge budget deficit in the United States, where we've combined tax cuts and spending exuberance on top of an economy that was already highly performing. And what that's done is put a lot of pressure on other countries to spend just as liberally. The American economy has been able to thrive so far with this deficit spending. Now, other nations that have the proclivity or perhaps compulsion to rein in their budgets find themselves strained and just unable to match the growth in the U.S. these days. Another explanation of why the international markets have been struggling, the interest rate increases from the Federal Reserve, which certainly seem like the right thing to do when looking at the strong American economy, have helped push the dollar higher, and other central banks are being much more passive as they struggle with their own economic issues. Now, rising dollar can often pull down liquidity in foreign countries, particularly the emerging markets, which are very dependent on debt. In extreme cases, a nation borrowing in U.S. dollars can be, in fact, ruined by a sharp rise in the value of the dollar. And that's happened all too often in the course of economic history, and fears of this continue to rock markets in such countries as Turkey and Argentina and quite a few others. So interest rate increases feed into the strong dollar, which not only reduces the value of the international investments directly, just via the rate of exchange, but it can also pressure vulnerable economies, of which there's no shortage in 2018. Another reason that seems like it's in the news every day that's really been negatively impacting the international side of things is all the assortment of tariffs imposed or threatened by President Trump. They have had significant impacts on the targeted countries. Remarkably, I have to say they've had no visibly discernible effects on the U.S. economy or markets. They're honestly doing just fine. But the targeted countries have failed to come up with a counter strategy. The Chinese stock market, and indeed emerging markets as a whole, are in the official definition of a bear market, down 20%. And the tariffs and global frictions have significantly impacted investments in those places. And I'm sure we'll chat more about them. And finally, and perhaps even least important of all the other reasons, it's just internal issues in the countries themselves. And whether in Europe, Japan, China, developing world, anywhere really, we can see conditions that are less than ideal from the economic and investment perspective. Oh, sure, but the weaknesses particularly become more evident in comparison with the U.S., where there's been a huge corporate tax cut, regulations are being stripped away, and just very favorable conditions from the investment perspective. So at this point, I kind of take a break from saying, oh, here's all the whys, here's what's been happening, the relatively poor showing from the markets. Does this tell us anything about what we should be doing now, which is really sort of the only thing that matters? And unfortunately, even knowing what happened yesterday doesn't give us too much guidance about what we should be doing today and tomorrow. So standing here kind of looking at the landscape, I'd certainly say there are reasons to be pessimistic about the international investment landscape, and we shouldn't just paper them over. So the trend, all those trends I cited above, they could well continue for the near term, there's no doubt. And it's obvious from the U.S. perspective to date, the tariffs have been effective and that they're bringing the counterparties to the negotiating table, and in some cases have won some concessions. And all this without any downsides to the U.S. economy. So this, I'm just going to call it bullying, could well continue, and the trends of ineffectual international responses could continue. So this sort of pessimistic scenario presented here, it would clearly argue to reduce international investments and concentrate on American companies. And maybe we can coin the phrase America first for that strategy. But I think that there are also reasons, and actually more reasons, to be optimistic about international investments and remain diversified internationally. The most simplistic, and also to my mind the most intellectually powerful argument, is that we just don't know what the future will bring. We do know the valuation of the American stock market is extremely high. Optimism is just rampant among investors. It's actually particularly worrisome in that so much of this optimism is being reflected in so many stocks. It's really hard to find a sector to hide in, to invest in, especially as compared to other nations' stock markets, in particular emerging markets, that are priced at much more attractive levels. Does this tell us what's going to happen tomorrow? No, it's no guarantee of anything. But the so-called reversion to the mean has actually always happened throughout economic history. And there's no reason to think it won't happen this time as well. Because another thing that people should contemplate very carefully is what if the U.S. economy does slow after this sugar high of tax cuts and spending. When that recedes and we begin to contemplate paying back the debt, it seems quite possible the economy will slow down. So in addition to these arguments, and actually almost to conclude, and I guess what perhaps makes me feel the most optimistic about how some of the international investments will start to fare is that I do believe that many of these trade issues will in fact be resolved. And the simple reason is because the other countries will realize it and it's in their best interest to make some concessions and move on. So for better or worse, the U.S. economy rules the world, and no nation or even a bloc such as Europe can really contemplate a breakdown in ties with the U.S. So for now, countries just have little choice but to accommodate some of the American demands. And I believe just this understanding, this meeting of the minds, will alleviate the severe pressure many countries are facing and allow things to settle down and resume their normal course. I do want to make it clear I'm not in any way endorsing this sort of might makes right stance, but I do feel it's more likely to carry the day simply because it's in other countries' interest and America's interest to negotiate, make concessions, and find a way to coexist and prosper. So with this, thank you for indulging that monologue. I'd love to hear questions and what's on everyone's mind. Did anyone have any thoughts or questions or just even observations about what they hear?
Hi, this is Marlene Ross. I see that the Federal Reserve is going to keep raising interest rates. That's kind of what the press is saying. Mm-hmm. So pressures will continue on these more vulnerable economies. So even if you think the tariff situation will get resolved in one way or another, I'm not sure I agree, but because I think when the other countries begin to negotiate, our country just raises the ante. So, but if the interest rates keep going up, then those pressures will continue, right?
I do agree with you. And I think that the ways that could change, and again, we just don't know, is one, if the economy slows down a little bit, they will halt the interest rate increases. Another reason they could possibly do that, as you know, they're being what they used to call jawbones. The president is making it very obvious that he doesn't want interest rates to rise. And quite often they've listened to his various demands. So we'll just have to see if anything happens with that. And throughout, I guess when there's been these sort of emerging market crises that have happened before, quite often the Fed or some other big lender like the IMF just throws money at the problem, and they lower the interest rates, they make funds very available, and things go forward. There's no guarantee that would happen, but it's happened before. But we're in unprecedented times with a lot of way that the government reacts to things that are going on.
This is Holly. What do you think of when you say a slowdown? A friend of mine thinks a recession is coming.
Well, they do pop up every so often, Holly, and for sure it's been 9 years since we had one, so it seems like one is due. It's always hard to say what could cause one. I do think clearly a major risk as well, if something truly goes wrong with China's economy or throughout Asia, that would probably have a pretty significant impact on us. It's, otherwise it seems like it's always something that we never expected. But, in general, these recessions happen because imbalances build up in the economy, whether it's manufacturers become too optimistic, or too many houses are built, or too many bad loans are made. And sometimes it only becomes obvious in hindsight. But definitely sitting here now, it doesn't seem anything is imminent, but then again, it didn't seem imminent in 2007 either. And that's kind of one of the ways that, we don't, again, what the Federal Reserve says, if everything just keeps going really well, we'll keep raising interest rates. And that was kind of the scenario that Marlene was referring to. But, they get surprised all the time by unexpected events. And that's the thing about a recession, is really it always catches everyone by surprise because, wow, it seemed like things were going so well.
Except for the debt ceiling. The debt
And
ceiling.
yeah, kind of the other. I'm sorry, Holly.
I just said that the debt ceiling is out of, it's totally out of whack.
Mm-hmm.
The deficit. The deficit. I'm sorry. Yeah.
Yeah. Yeah, I mean, just to think that we would run a $1 trillion deficit when we have a 3.5% unemployment rate seems kind of absurd, and yet there's really, besides maybe the callers, the people in this room and the people calling, there doesn't seem to be many people on either end of Pennsylvania Avenue that are very interested in talking about that. So kind of the fiscal conservatism in Congress have kind of gone away, and there's really not much, there hasn't been much to restrain what's been going on. Pretty scary, we have to say.
I say, yep. Yeah.
Nate,
I don't
Stephan,
think they've gone away. I think they're just hiding for the moment.
Yeah, that's probably a better description.
Yeah.
Nate, Stephan here. You're seasoned hand. You've been doing this for a long time. Are we truly in unprecedented times, or is this a time that you've seen before? And the overall course that you've laid out of staying the course is what has proved useful and beneficial in the past. And I guess the second question would be, what indicators would maybe change your thinking that there would need to be some dramatic changes in the allocations of the portfolios?
Thanks. Those are great questions. And honestly, what I meant by unprecedented times, it was times where it wasn't clear that governments would cooperate to help the overall economy. So, for instance, like a lot of diplomatic tiffs and things like that, and maybe Turkey's coming to mind, are rather than being settled through diplomatic means, are being addressed by economic punishment measures and things like that. And also, it's unclear, whereas if certain countries got into trouble economically, if the world, if you would throw them a lifeline. And that, to me, it's unclear if that would happen right now. And I am going to say that's unprecedented because since World War II and the institutions of the World Bank and IMF were set up, basically countries, at least not talking about communism, but on the other side of the wall, did cooperate and conferred with each other and supported each other. And I have to say that's not really clear if that would happen right now. So that was kind of what I was alluding to with that. And the second of which, I guess we would have to see if this notion of various countries looking to compete with each other economically, but not just compete, but to try to punish their trading partners in other countries, if that was really going to become ingrained as the new world order that we have to live in going forward, I think that would really necessitate a complete rethink of everything, because, gee, what does the world look like then where everyone is trying to outdo their neighbor at whatever cost to themselves? That's not a very pleasant scenario. And I would say maybe we've taken a step or two down that path. So, wow, that's a really long path. And, we have not even yet gone through an election cycle in which the United States electorate will get to decide if this is a path that they like or not. But I guess we'll get some clues on that in a couple of months and again in a couple of years. But based on kind of the indications of what's been happening, it doesn't seem like that's the direction that everything is going to go in. But I would definitely, obviously we all have to kind of hold our breath and monitor it carefully and hope that some of the, I say voices of reason, but just, the the kind of the restoration of the notion of cooperation and shared values and goals will kind of reassert itself, and then again just emerge into a more stable environment where we can just rely on what has happened before, at least to the extent that economies will grow and trade will grow, and that other areas, areas of the world will develop at their own pace.
I think you're more
thought-provoking question. Go ahead, Marlene.
I think you're more optimistic than I am at the moment.
Yeah, I think we're 50-50. Sometimes you win, sometimes I win. The optimism, Peter. I would say, one of the things that we just have to say is and I think I said this myself, and I'll just be honest that I was wrong, that I said, well, once these tariffs start coming in, or once they really start getting enacted, wow, look out, because these companies are just going to fall through the floor. How are these companies going to be able to continue making money with all this antagonism? Apple makes as many sales in China as they do in the U.S., GM a lot more, Boeing, I could just go through and through and through. And wow, what is going to happen to our stock market when these tariffs come into effect?
Right.
And I was pretty pessimistic about that. And, the impact has been zero. So
yeah, but what they're doing is moving production to those countries. So that Apple's done some more of that, and Harley Davidson. So they're taking a different approach. And of course, the president is not happy with that.
Yeah, but no doubt. But from the investment perspective, it's been fine. Again, every individual thing will have its own winners and losers. But,
right.
The Dow is at 26,000, and the unemployment rate is 3.7 or 3.8%, and inflation is 2%. So, I guess we'll just have to see how things unfold. But so far, some of the real worries about this have not yet played out. Now, do I wish they would all just go away? Oh, yeah, I do. Because I think we'd be in an even better position if all these things weren't happening. But they have happened, and the worst case scenarios really haven't played out. And actually, in many cases, it's been better than was expected, at least for the U.S. Now, again, this is the whole theme of the call for the international economies and investments. It hasn't been very pretty. And that's something that we'll have to, we'll just see how it plays out with our portfolios and everything else. But, to date, that's what's happened. And again, if some agreements can be reached, like with this kind of mini NAFTA, the agreement with Mexico to make tweaks to NAFTA, and the Mexican peso has done just fine since then. Their stock market has done just fine. And there's no reason to think that when we have the agreement with Canada, which obviously, I'm just going to say it, obviously is going to happen, an agreement with Europe that, I'm just going to say it, is obviously going to happen, that things, won't just right themselves and go back to whatever normal is in the year 2018. But definitely better than it's been over these past 6 months.
Yep.
Nate, this is Dustin. What is your outlook on the bond markets?
Well, I'm just going to say, let's just hope that we don't make too much money from our bonds. So the way the world is kind of right now, the only way really that the bonds will make a lot of money for us is if the economy goes into a big slump. And then the bonds will, support our investments as they did. I know we didn't know each other in 2008, Dustin, but as they did then and as they have through other recessions. Otherwise, it's kind of steady as she goes, and maybe, we're just looking at a few percent from the bond investments. And it's always possible that inflation will come out of nowhere and become a big risk. But this is something I have been saying for 15 years, is that I just don't see it. I still don't see it. And that's the biggest challenge. That would be the biggest challenge to bond investments, is just a sudden emergence of inflation. And I'm going to stick with my stance for 15 years that I don't see it. Well, these have been some incredibly thought-provoking questions. I'm pretty sure I'm going to sleep very well tonight. Any others? I still have a couple of brain cells left, if anyone. Don't say anything, Marlene.
No, I was going to say your job is to help us to sleep better at night.
That's true. Well,
Yeah.
Nate's sleeping better than I'm
this is
sleeping better. Anyway, go ahead.
Nate. This is Ed. It's been a great conversation today. I wanted to, as the proverb goes, "May you live in interesting times." I guess. I wanted to ask if you could do some crystal ball gazing, given that some of the exuberance in the markets, no doubt, is psychological to some degree, but the impact of an election where we have a divided Congress and the current president, what are your prognostications about what that would look like, or what kind of impact would it have psychologically on the markets?
Well, in the markets, it's difficult because usually when we have a divided government, it seems like the markets end up doing just fine. And honestly, I try to be very apolitical, as you know, Ed, and everybody else does too. But actually, after seeing some of the works of this Congress, a divided Congress would be a great thing. It would really be we could at least be assured that we wouldn't have any more unnecessary tax cuts and some of the other quasi-legislation that's been passed. Now, there would be, unfortunately, the downside, I'm going to say the downside from an investor perspective, is that there would just be a lot of noise on the periphery about, impeachment and investigations and things like that really don't add very much to the global economy. But a lot of times the divided governments can end up working out very well because it does compel compromise, and that's even one of the themes of even the situation internationally, is that when compromise is the only alternative, that can be a huge positive. And we've had a few eras of divided government, actually quite a few over the past 20 years, and in general they worked out pretty well for investors. And certainly many of the years when Bill Clinton was president, and some of the other years during the Obama years, they were able to compromise enough when it was necessary to keep things going, and without dramatic swings one way or the other, which as a general proposition is what investors would prefer: stability rather than huge changes.
Thanks very much for that response. Very thoughtful. Appreciate it.
Thanks, Ed.
Nate, this is Stefan again. Sort of a final question, and again, thank you for your great presentation today. Among peer organizations like yours, would you say the strategy that you're advocating and following is the predominant strategy? Are you seeing other firms sort of take radically different strategies of reducing their foreign holdings, or doing the reverse, predicting a recession and beefing up their foreign holdings right now? Would you characterize sort of where the portfolio is like this is what we see most of those who are in the know, who follow the markets, are doing: hold on to existing foreign assets and keep the allocation pretty much as it is? A tough question in terms of you're commenting on what maybe your competitors are doing, but I just wondered, do you look at what you're advocating as sort of in the norm of what others are also doing?
Stefan, you really, no, those are just fantastic questions. And obviously no one divulges anything, but I think I know enough about how the investment world works, whether it's our competitors or just hedge funds or mutual funds. They usually buy what's going up. Okay? So you look throughout the mutual fund landscape or the hedge fund landscape, wow, you are going to see a lot of Apple and Amazon in there, because they look so great when you show them to your investors that, hey, look how much we just bought of Apple. I mean, they're so dominant. Of course we want to own them. And I can just, you can play that along the way. And I'm sure sometimes we don't actually see what happens until after the fact. But the major reason why so many mutual funds, and that includes hedge funds, private equity, you name it, is that they buy what goes up. And that is a ticket to mediocrity. And I think what we try to do is, even if maybe we're not necessarily adding to something that's gone down, but we don't sell it when it's down. So, for instance, obviously right now we've got, emerging markets, whether you just want to say the name Brazil or India or South Africa, they're struggling. In my opinion, the very worst thing that we can do is sell something when it's very low. Even though that might make us feel good, we unloaded that one before the worst really happens. But that just doesn't work. It's much better to just, let it ride out and wait until things self-correct, which, again, they always do. They just always do. And, the trick with folks who are living off their investments and can't just say, oh, we just can't sit back and wait. Well, that's why the diversification comes in, because obviously if someone had a portfolio of 25% India, 25% Brazil, 25% Russia, 25%, Taiwan, oh, gee, I mean, they're out of luck. But that's why we really have true diversification among all different kinds of bonds. And of course, we have lots of American stocks too. And, when it's made sense to sell them over the past few years, we have, and the market's kept going up. But that's, in general, we try to implement that kind of philosophy and really, I'm going to say, try to really maintain a good discipline to that, to sell high and even if not sometimes buy low, but at least not sell low. And without disparaging any peers or anything like that, I think many folks in this industry find that very hard to do. Just because you have to show your clients what you're holding, and you've got a Latin America fund in there, and it's gone down X percent. Well, that's a loser. We should sell it. But no, it's just what happens in the world. Certain things will go up and down at different times. And the way to avoid locking in losses is to avoid selling things when they're very low.
Thanks, Dave.
Thanks, Stefan. Well, thanks, everybody. This was truly a great experience for me. And just, I will say the questions were much more enlightening, I think, than my introduction. So thank you for that. What we are going to try to do, and I mean, we'll succeed, will be to put a recording of the call on the website. And I'm probably going to attempt to translate the words that I were saying today into legible English. And we might just send that out to everyone as just a little essay or just a more comprehensive summary of our thoughts and what we're just what we're seeing in the world and what we think about going forward. So with that, again, just mine and all of our just deepest thanks for joining in and just everything, all your support through the years. It just means everything to us. So I wish everyone a great evening, and we'll be in touch soon.
Thank you, Nate.
Thank you.
Great call, Nate. Thank you.
Thanks.
Bye.
Thanks.
Bye.